Hi all, I'm Dave Byrd. I'm a research scientist here at Georgia Tech who primarily studies time series machine learning, and I'm also the head TA for the class you're taking right now, CS 7646 Machine Learning for Trading. I also teach the class sometimes on campus when Dr. Balch is not. Last summer when I taught the class, I gave a sort of impromptu basic options lecture in response to some questions from students, and it was very well received. And so Dr. Balch asked if I would please record a version of that lecture to permanently include in the online version of the class. And that's what you're going to get here today. Do expect me to cover a bare bones introduction, assuming you don't know anything about exchange traded options. So I'll cover what they are, what it means, how to read an options chain, what are call and put options, what are some basic strategies that you can employ with options, what's the purpose, how do you price options, and how can you combine different options contracts in order to get more advanced strategies that let you take a specific position in the market based on a very specific opinion that you have about what's going to happen that can go well beyond just long or short. Please don't expect this to get into any kind of advanced topics like the details of the Black-Scholes model, or how to trade the volatility smile, or how to manage your positions over time, rolling out and down if your position goes against you. We won't get into any topics like that, but hopefully we'll give you a good, quick, broad coverage of the basics, and you'll walk away from it at least knowing what exchange-traded options are and how you might want to consider approaching it from a machine learning perspective to see if you can include it into your bag of tricks. All right, I'll get started, and I hope you find this useful. Okay, so the word option is used to mean several different things, and I want to start by distinguishing that anytime I say the word option during this talk, I'm referring to exchange-traded options. So at no point will we be talking about employee stock options, such as you might get when you go off to your fancy tech company. That's a completely different beast. It's not something we can publicly trade in on the market, and therefore not what we're after in this class. So here option will mean an exchange-traded stock option, such as on the CBOE or Chicago Board of Exchange. An option is a legal contract which gives you as the buyer the right, but not the obligation, to buy the underlying stock at a specific price on or before a specific expiration date. For this first part of the talk, I'm going to assume we're talking about buying call options only, which means buying the right to buy the stock. We'll get into some of the other details later, but just to be unambiguous, right now we're buying call options, which is buying the right to buy the stock. So I have a few caveats in the definition here. There are options on many other underlying assets besides stocks. There are options on future contracts and commodities, options on currencies, all kinds of other things. When we say we're going to be able to buy the stock at a specific price, we call that the strike price. And when we say on or before the expiration date, we're talking specifically about US style stock options. In European style options, we can execute the option on the expiration date only. Under Euro style, you cannot choose to exercise your option prior to the expiration date, but in US style you can. So with those caveats, let's actually look at an option chain to try to make all of this real so that we have kind of a common position to go forward with. So this is the option chain for call options on Apple stock. I took this picture the day before I originally gave the lecture in the classroom in November, and it was for the December expiration date. So we can look through the options chain example that I have here and see what some of the different data points mean and how we can interpret it. The first column here is the expiration date. So all of these options expire December 16th, 2016. If you were to buy one of these options, that would be the date by which you would have to use or exercise the option, or else it just simply goes away. The second column is the root column. Root here is just jargon that means the underlying security, in our case a stock, that this option is tied to. Strike is that strike price we mentioned. This is the price that you will be guaranteed to be able to buy the stock at if you choose to exercise the option. The key to these options is you can choose to buy at this strike price no matter what the real price of the root security is on the day you exercise the option. That's kind of where the power and flexibility comes from. The last column is because I took this after market close on that day. So it's showing the last price that each of these options traded at on that day as the market closed. Net is simply showing the change from the previous time period. Bid, ask, and bid size and ask size are all 0 because the market was closed. So of course there were no open orders at that moment. If you looked at this during the day, you would see some order book information here about what the current best bid and best ask price were for each one of these. And then the open interest column is kind of interesting. This shows how many total positions of this option are open and in the market right now. So one thing you'll notice about this that's kind of interesting is humans like nice round numbers. The interest is much higher for no really special reason necessarily in all of the prices that end in a multiple of 5. Just a little bit of humans being humans there. So what are we doing with these option contracts? An option contract controls 100 shares of the underlying stock. It's always 100, never more, never less. But when I look at these prices, options contracts are always priced per share. I don't know if that's just a historical artifact or if it's salesmanship to make options look cheaper, but this is how it's always been done. So if I look at this $110 strike price for Apple, and I see that it costs $2.73, what that means is if I buy a single 110 call option on Apple, that option will control 100 shares of Apple stock, and my actual price that I pay for the option will be $2.73 times the 100 shares. So this option will actually cost me $273 if I wish to buy it. So I can buy one contract of the Apple December 16th, 2016 call option at $115 strike price for $273, which is $2.73 a share. Then, anytime the market, and here again I mean typically the Chicago Board of Exchange, is open before December 16th, I can choose to exercise this option. If I exercise the option, whoever sold me the option is obligated to sell me 100 shares of Apple stock at exactly $110 a share, no matter what the price of Apple stock is on that day. So by itself, buying this call option amounts to a bet on my part that Apple stock will rise to at least $110 by the expiration date. Almost. I actually paid money for the option, and when I'm calculating my break-even price, I really should factor in the money that I paid to buy this option, because that is a lost expense. I don't get that money back. So what I really need is I need for Apple to rise to $112.73 per share so that I earn back the $110 that I would spend buying the stock if I exercise the option, and the $2.73 a share that I spent to get the option in the first place. And then if the price of Apple on that day is $112.73, I break even, and if it's anything above that, I make money by exercising the option. And if it's anything below that, I would lose money by exercising the option. I am ignoring trading fees here, which I'll do throughout the lecture because that complicates things in unnecessary ways. So what's the point of buying the option? Why wouldn't I just buy the stock? So a perfectly reasonable question to ask is, why would I buy an option when I could just buy the underlying stock directly? There are some disadvantages that we'll talk about in a second. So what's the advantage? Why would I do this? And it will help to look at a specific scenario. And so I'll look at Apple stock again, and I'll use that same 110 strike price with a $2.73 value. And I'll tell you that on the day that I first prepared this presentation, Apple stock was trading at 111.57. So Apple on some day is 111.57, and we're considering what to do. We think that Apple stock will go up in the near future. We could buy 100 shares of Apple stock today. It's a nice round lot. Your broker will like you. That's how you minimize your commissions. And that will cost us $11,157. That money disappears from our account, it's gone, and we get 100 shares of Apple stock in exchange. Let's say that the price of Apple does go up like we hoped, and it rises to $120 a share sometime on or before the theoretical expiration date of the options that we're talking about but didn't buy this time, we just bought the stock. Then we could sell our stock for $12,000. Even if we don't sell it, that's still the paper amount that we're worth, and we can still calculate a paper gain. And then we have a profit on this particular trade of $843 minus trading expenses, which again I'm going to ignore. That's pretty good for holding the stock for something like 2-3 weeks. Instead, we could have bought an option contract. And the option contract we looked at was the 110 call, and that would cost us $273 to buy. Now, in the same situation, if the Apple stock rises to $120 a share by the expiration date, then we could choose to exercise our stock option, which allows us to buy 100 shares of Apple stock at the 110 strike price that we agreed on when we bought the contract. So buying that stock on that day cost us $11,000. And then we can immediately sell the stock the same day at the open market price for $12,000. So doing that, our profit is only $727. It's a little bit less, but we got to participate in most of the upside move in the stock. And you can already see one of the benefits that we obtained by using the option instead of buying the stock. And that is, we only tied up $273 in our account, and the rest of the cash was still there in the account available to use. Compared with if we had bought the stock, we would actually have to tie up the full $11,157, and it would not be available to do anything else with during that time. So this is the leverage aspect of options, and one reason that we like them, because you can control more money using less money. So the other case to consider is, what if the stock doesn't go the way we expect? So let's run through that same exercise again. Apple stock today is $111.57. We could buy 100 shares for the same cost as we talked about before. And now we're saying, what if Apple stock falls to some amount, let's say $100 a share by December 16th? Whether we sell it or not, we still have the same paper loss, so we can treat it as a sale. Now our stock is only worth $10,000. That means we've got a current loss of $1,157. So that's a pretty big loss for just a few weeks. Apple's stock price may not actually move this much, but it's an interesting and illustrative example. Now, what would happen if we bought the option? If we buy that 110 call for $273, and then we assume, again, that Apple falls to $100 a share, and it stays there until the option expires, we simply don't exercise the stock option. Remember, this is an option. That's the entire point. We're buying the right, but not the obligation to buy the stock. So we don't have to use it if we don't want to. And if we're below our break-even price, we won't. We'll just let the option expire, and at least it won't do any further damage to us. So in that case, our loss is just the $273 that we spent buying the call option, no matter how low Apple's stock price falls. If you want to make the numbers even more extreme, imagine that something terrible happens and Apple goes out of business. Then if you bought the stock, you lose every single dollar that you had in it. If you bought an option, you lose exactly the premium that you paid for the option, and it doesn't matter what happens to the stock after that. So these are some of the reasons that we like options. First, you cannot lose more than the premium that you paid for that option up front. No matter how far it moves against you, you can't possibly come out worse than losing the premium you paid for it. And second, we like it because leverage. So we still get most of the upside potential if the stock goes the right way. Not quite all, but most. And in exchange, we've capped our downside to the premium, and we've tied up a lot less money in our account, so we could go out and take more bets and diversify our opinion about the market in more directions. Now, it's obviously not all good. If it were just this, then you would say, well, so why should I ever buy a stock instead of just always trading in options? And there are some people who do that, but there are downsides to options, and a couple of them are, first, the premium is lost money. It's gone, you pay it immediately to another person when you acquire the option contract, and you don't get it back no matter what happens to the stock. Second, options have expiration dates. This is a biggie. You're adding a layer to the bet that you're making in the stock market. If I just go buy some stock, I'm betting that that stock will go up eventually. I'd like it to go up sooner rather than later, but it's okay if it doesn't. I can just hang on to the stock and forget about it, and someday in the future, when the market goes back up, I can sell the stock at a profit. Yes, I've tied up money for longer. Yes, I couldn't close out the position maybe when I wanted to because it was in the red, but I never have to sell it. I can just hold on and hope for the best. With an option, you can't do that. Options have a built-in time bomb. You're now taking a bet that the stock will move in a specific direction by a specific amount or more, and in a specific, usually pretty short time period. So there's a lot of benefits, but you're also now making a much more specific bet that's more likely to be wrong because you've got timing and all these other elements that you don't have if you just buy the stock. And then the third thing, of course, is you don't own the stock. Now that sounds kind of trivial, but there are implications to the fact that when you buy an option to buy the stock, you've not yet bought the stock. So the person who sold you that stock option still owns the stock until you choose to exercise it. And that means while the stock price is going up before you exercise the option, they have the voting rights that might come from that stock, not you. And they are collecting the dividends and any other benefits of ownership of the stock, not you. So let's talk for a second about the moneyness of an option. This is one of those words that you don't tend to hear in casual conversation, and I'm not totally sure it's proper English, but it is a common financial term. Why are some options so much more expensive than others? If you look back here at the option chain that we're studying, for example, down at the bottom of the page, we've got the 117, 118 options that are only 20 cents, 23 cents per share. But then up at the top, the 102 strike price option is currently trading at $9.05. So if you were to buy that for your 100 shares you're controlling, that would cost you $905 for one contract. Whereas the 117 would only cost you $23 for a contract on 100 shares. Why is that? And the answer is, right now, as of the day that I did this, Apple is trading at 111.57. So Apple is trading right there in the middle of the table between those 111 and 112 strike prices. If I were to buy that 110 call option that we keep looking at for $2.73 a share, I could exercise that option right now, one moment after I buy it, for a profit of $1.57 a share, because Apple today, right now already, is trading $1.57 above that 110 strike price. So the option is obviously not going to be priced less than that $1.57 a share that I could get if I bought the option, exercised it, and sold the stock immediately all in one go. That is what we call the intrinsic value of a stock. So that's the difference between an option's strike price and the current underlying spot price for an in-the-money option. And all we mean by in the money is, this is a little recursive, but it's an option that currently has a non-negative intrinsic value. So you could make money immediately by buying the option, exercising it, and then selling the stock. Something that doesn't have intrinsic value is called an out-of-the-money option, meaning currently you could not exercise that option at a profit because of where the stock price is right now. And then if you're right on the border between those two, you can be at the money or near the money or any other language that you want to wrap around that. So we said intrinsic value right now is $1.57 a share for that 110 strike price, because that's what we could get if we sold it right now, immediately after buying it. But it's not priced at $1.57 a share, it's $2.73. So what is the rest of that price? The 110 costs $2.73 and has an intrinsic value of $1.57. The 115 has an intrinsic value of 0 because Apple is trading less than that right now. So it's not currently worth anything in the sense of exercising the option, but it still costs 53 cents a share or $53 for the contract. So there must be some other component to this. And the other component is what we call the time value of the option. The more time there is between now and the option's expiration, the better the chance there is that the stock will reach the strike price before it expires. And so the higher the time value will be. So we can say the excess premium cost then, that's beyond whatever the intrinsic value of the option is attributed to its time to expiration. You can think of that as the amount of time that the stock has got to move the right way before the option expires. And you'll see, of course, the further you are from the expiration date, the bigger that time value will be. And then as you get closer to the expiration date, the time value shrinks, and shrinks especially rapidly in the last few days and really the last few hours before the expiration, as it becomes nearly impossible that the stock will reach each strike price. Now, you're not stuck with options once you buy them. These are not something that you buy and then there's no market for it to sell it secondhand. These can be bought and sold just like stocks. So if you change your mind on the option after you've bought it, you can sell it on to someone else via an exchange like the Chicago Board of Exchange. But you'll probably lose money if the stock hasn't gone your way fast enough because of time decay. As you hold this option and the price is not moving or it's not moving the correct direction, the time value of the option will be decreasing because there's less time before the expiration date for it to make that move that you need on an out-of-the-money option. So this is also called theta. It's one of the Greeks that I said I wouldn't talk about much. There's a lot of Greek letters that are used to describe different secondary characteristics and derivatives and second derivatives of various factors of options related to stocks. And if you get really into trading options, you'll want to go study them. But this is the only one that I'll mention. So theta, or time decay, is the rate at which an option is losing its time value, which is to say it's the first derivative of that time value over time. The time value changes more rapidly as the expiration date arrives, and the time decay goes up. And then when you get to the expiration date, of course, time value approaches zero, and all of the option prices will approach their intrinsic value, because you would have to buy it, exercise it, and sell it immediately at that point. It's just about to expire. The last 2 weeks are when time decay goes the fastest. So people who want to actively trade options as opposed to hoping to exercise them and get the stock usually try to close out their open option positions at least 2 weeks before the expiration date. So the smart money is really not in there at the last second trying to do option trades that are about to expire. They're buying those options a month or 2 months out and then selling them as you get to 4, 3, 2 weeks away from expiration on to somebody else who actually wants to make that bet about whether the stock will end up in the right place and they'll get to exercise the option. If all of this part about the Greeks and time decay is really interesting to you, you may want to go look at the Black-Scholes model, which is not machine learning related, but it is one of the very common financial models that's used to decide what should the price of an option be at any given moment. And a lot of people use deviations from that model to try to do arbitrage on options where they've moved away from the expected price, and you might expect some reversion to the mean. Now, I've made an assumption so far about the options that we're talking about. And I mentioned it briefly at the beginning, but I want to state it again because then I'm going to relax that assumption and talk about some other types of options. Everything I've talked about so far has assumed that you are buying a call option. So a call option is equivalent to a long position. It's going to profit if the underlying stock goes up. And you have been buying it, which means you're buying the right to buy the stock. But there are several other basic things you can do with options even before we get to the complex strategies. And I want to go through those in just a second, but as I introduce each one, I want to show you a common profit and loss curve that we look at in options that makes it very easy, once you get accustomed to looking at it, to understand exactly what an option strategy is doing, and particularly to understand exactly when it will make money and when it will lose money. And it's a really helpful visualization. So I want to start by introducing it for the call options that we've already been talking about. What you see on the screen right now is kind of the basic grid that we'll always use for this profit and loss curve for an option strategy. So at the bottom, we'll have the spot price at expiration of the underlying security. So in the case of our example, this bottom axis would represent what is Apple's stock price at the time that the option expires. And we'll draw a line vertically in the middle of it at the strike price. It doesn't actually matter what the numbers are here. When we visualize these things, we're just saying under this strategy, where is the spot price at expiration relative to the strike price of your option? And that will give you the appropriate shape of your profit and loss curve, even without filling in the precise strike prices and dollar amounts. And on the vertical axis, we'll have profit and loss, again with zero kind of centered in the middle, where we break even on the entire thing, and we will include our premium as part of that. And then if we're above that, we're making money, and if we're below that, we're losing money. So to make that make sense, let's look at a simple buy call, which is what we've been talking about up to this point. So when I buy the call, we've already said that I'm paying some premium up front, and that's money that I'm in the hole immediately as soon as I buy the option. And then I need for the stock to rise to some amount above the strike price that represents that extra premium that I paid before I've actually broken even and recovered all of the money that I spent, plus been able to sell the stock and get back to zero. So if I look at the P&L curve for a standard buy call, we start over here at the left end with the spot price well below the strike price. So in other words, the stock price went down, doesn't matter how much, it just went down quite a bit below the strike price. And no matter how far down it goes, I've lost a dollar amount that exactly correlates to the premium that I paid. And that's going to be the case until I get to the strike price. As soon as I hit the strike price, I'm still losing money, but I'll start losing less. Because once I hit that strike price, I will exercise the option, because I'll make at least a little bit of money exercising it, buying the stock at the cheaper price that I have, and then selling it at the market price. And in fact, that'll be $1 for $1. For every dollar that we go above the strike price, I'll make $1 per share of profit, not counting that premium. So this is just a simple linear relationship. And then once I have exceeded the strike price by the premium, I finally reach my actual P&L break-even point, where now I've been made whole on this entire trade. I've got back to zero, and I haven't lost any money. And as I continue to rise above that, I'm actually finally in a truly profitable position, having bought this call option. But buying calls is far from the only thing you can do, and kind of the further away we get from it, the more interesting it will be. So I want to talk about some of the other things that we can do with options. As I go through each one, I'll also note, just as a point of interest, what is the maximum profit and the maximum loss that we could experience for each strategy, because that's one useful thing to think about. And here on the buy call, it's very simple, but do notice the maximum loss I could possibly experience is my premium amount, which we had said before. The maximum profit from buying a call is theoretically unlimited, because there's no amount where the spot price of the underlying stock would have to stop going up. It could go up any amount. And I profit dollar for dollar along with it with this position once I exceed my break-even point. So the other basic type of exchange-traded stock option that you need to know about is the put option. A put option is essentially the opposite of a call option. You'll buy it just the same, and you'll pay a premium when you buy it just the same. But now, instead of buying the option to buy the stock, you're buying the option to sell the stock. You don't have to own the stock to be able to do this, because you're probably going to have a margin account if you're playing with options anyway, and you can short the stock as part of your exercising of it and then immediately buy it back to close out the position. So if we look at a buy put, we would expect the P&L curve to be opposite in some sense, and indeed it is, because now we're making a bet that the stock will go down and we'll be able to sell it or short sell it at the strike price and then immediately buy it back to close the option position and the stock position at whatever the price is on that day. So we'll be able to sell it for more and then immediately buy it back for less and pocket the difference. So our cost curve is going to be almost exactly the opposite. If the stock closes above the strike price, we will experience our maximum loss, which will be the premium that we paid for this put option. If we get down to the strike price, then we'll start recovering some of our money. Again, $1 for $1. Every dollar that the underlying spot price goes below the strike price, we'll earn back $1 of our premium that we spent until we finally get up to a true break-even point where we've recovered the full premium. And then for every dollar that the stock falls below that, we'll earn $1 of profit per share that's covered by our option contract. There's one important difference to note though, and that is with a put option, we actually have an axis over here to run into. So our maximum loss is still limited to our premium, but our maximum profit is no longer unlimited because the lowest that the stock could go is $0 a share. So there is going to be some limit, which will essentially be the strike price minus the premium, that will be our maximum profit because, again, we can't hope for the stock to do worse than go to zero, stop trading, and the company go out of business, and that will limit the maximum profit we could make. There are a couple of other things that you can do, even with basic options though, that I want to talk about. Everything so far has assumed that we're buying an option. But if we're buying options, someone must be selling options. And there's no reason that we could not be the person selling the option instead of buying it. Typically in options, this is called writing the options contract, W-R-I-T-I-N-G, writing. So let's look at what happens to the cost curves if we write options instead of buying options. So to explain writing a call for a moment, it is the exact opposite in the other way between a call and a put. When I write an option contract, I am selling someone the option that until the expiration date, they can force me to buy or sell them the stock at the strike price, whether or not I want to, and no matter what the price of the underlying stock is on that day. So for example, with a call, I am selling someone a call option. I collect that premium payment immediately, and I get to keep it no matter what. But then until the expiration date, they can buy my stock away from me at the strike price no matter what. Now in the best case, they won't exercise that option. I got their premium, I keep it, and I keep my stock. But of course the downside is I might be forced to make a very unprofitable trade at some point prior to the expiration date if things don't work out well. So here you might expect that the profit and loss curve will end up upside down of where the buy-call curve was, and you'd be pretty much exactly right. If we write a call, we flip that cost curve over. So the first thing that happens is we now collect the premium for writing this call option, and that's cash in our pocket. So as long as the stock expires below the strike price, meaning it would be unprofitable to to exercise the option for the person who bought it from us, we have a profit equal to that premium we collected, and they will let the option expire. Once we get up to the strike price, then the person who bought the option is earning dollar for dollar, because now they will exercise the option since it's above the strike price, and they're gaining a little bit back dollar for dollar, and we're now losing dollar for dollar because they're going to exercise that call and take our stock away from us at a disadvantageous price. But we're still sort of okay until the stock price gets to the strike price plus the premium. And then at that point, we are actually overall losing money on having written this option, because now the person at the other end is going to exercise it, take it away from us at a very disadvantageous price compared to the current price of the stock, and our premium we collected was not enough to make up the difference. Writing calls, which by the way are called naked calls if this is your sole position and you're just doing it without any other strategy attached to it, and that's meant to suggest that it's probably a bad idea, and here's why. Our maximum profit is now limited to the premium. There's no way we can make more money than the premium. Now that could be okay if the odds of that happening are very, very high, but here's the slightly scary part of it. Our maximum loss is now unlimited. This axis down here doesn't really count for putting a floor because it is just the profit and loss axis. We're not saying the stock price goes to zero. This is our loss. So now the stock price could theoretically go up without any limit, and the more it goes up, the more money we lose. So we have to manage a strategy like this very carefully to ensure that we don't lose essentially some arbitrary unlimited amount of money. Writing a put actually does not have that same unlimited loss potential, because we'll flip the cost curve back the other way, so it'll be left to right opposite of writing a call, and it'll be top to bottom opposite of buying a put. So if we write a put, we've now got a floor under us, which is, again, the stock can't go down any lower than zero. So when we write a put, we give someone else the option to sell us the stock at the strike price should they choose to do so. So now we want the price of the stock to go down because we don't want the person to choose to sell us the stock. Because if they do that, it will mean they're winning and we're losing. So as long as it stays above the strike price, then we've got the premium that we charged in our pocket as profit, and that is our maximum profit. Once the stock falls below the strike price, we start losing money dollar for dollar. We break even when it's the strike price minus the premium, and then we start actually losing money on the trade, at least with a floor at some point of the stock hits zero and we can no longer lose any money beyond that point. So our maximum loss here will be the strike minus the premium if the stock goes all the way to zero. The good news about writing options is 90% of stock options that are bought are not exercised. So while it may seem strange to take these trades where you've got potentially large losses and small fixed profits that are your premiums, you have to realize that the odds of these situations happening are not equal. Most options expire unexercised, which means most of the time with writing an option, you'll put that premium in your pocket, and that's the end of the deal. The option will never be exercised. But you've really got to watch out for that small percentage of the time when it is exercised, because you could lose your shirt. Now this is just the 4 basic things you can do with a single options contract. You can buy a call, you can write a call, you can buy a put, you can write a put. But the real power of options is not in doing these naked calls or naked puts or even just buying or selling puts. It's putting these things together with some other strategy to let you take a more complex position, or to hedge your bets, or to make a very precise bet on what you think is going to happen in the market. And I want to talk about just a couple of those before I wrap up. One of the most basic strategies that's considered one of the most safe things you can do with options, and in fact many brokers will allow you to do it even in a cash account when you haven't been approved for margin, is the covered call. The covered call is a very simple strategy that combines one option position with a position in the underlying stock. So to enter a covered call position, what you would do is buy a stock and then write a call on that same stock. So you're giving someone else the privilege to be able to buy away from you a stock that you do actually own. We should look at the possible outcomes of this to understand kind of the purpose of the strategy. So there's three basic possibilities. The first is that the stock ends up above the strike price before the expiration date. This is not really ideal, but it's not so bad. So if that happens, then our stock will be called away, meaning that the person on the other end of that call option will exercise it and buy our stock from us below the current market price. So we'll be obligated to sell our stock at the strike price, which means we miss out on any of the profit above that strike price if the stock continues to move, because now we don't own it, the other person owns it. So our total profit in that case is the strike price minus the original purchase price of the stock plus the premium that we collected when we wrote that call. It's not the end of the world. We still made money, but we didn't make as much money as we would have if we had just bought the stock and not written the call, because then we would have gotten to fully participate in that profit as the stock moved up. The other problem is, of course, we don't have the stock anymore. And so if we really wanted to be in that stock, we think it's going to continue up, now we have to go buy it again. The second option is that the stock could go up, but not up enough to hit the strike price of the option that we wrote. And this is actually the perfect thing that we want to happen, is this middle situation, because now the option will not be exercised because we're below the strike price, and the person on the other end would lose money by exercising the option. And we're in a perfect position now because the stock went up, so we've gained money on our position in the stock, and we still have the stock and can write another call or anything else that we want, and we collected a premium that has accelerated our return on the stock that ended up not costing us anything. So our profit so far on this stock that we still own is the current price of the stock minus the purchase price that we paid for the stock plus the premium that we collected for selling the option that was never used. This is where you would love to be with a covered call. You'd like to be in this middle range where you never actually have to sell the stock. So you end up making the full same amount of money as if you had just bought the stock and done nothing with options, holding the stock the whole time it goes up. Except periodically you're juicing those returns and getting more money than you would otherwise because you're writing calls and collecting premium that's just extra money to you. And then hopefully it's not exercised and the stock keeps going up slowly, never hitting those strike prices, and the premiums are just extra money that you put in your pocket the whole time. Of course, there is the other option, which is the stock goes down. If the stock goes down, the covered call still helps. It really only becomes a hindrance if the stock goes way, way, way up and we miss out on that stock move. If it goes down, the option won't be exercised and we'll still have the stock. Of course, we've lost money because our stock went down. But our loss to date is the current price minus the purchase price of the stock plus the premium, just like the last case. But realize what that premium is doing here. That has partially offset the loss that we would have had anyway from holding this stock during a downturn. So by writing these covered calls, we've gotten to hold the stock through a downturn, and we can wait for it to go back up and recover our money. But in the meantime, during the downturn, these premium payments we're collecting are helping to offset the losses. So a covered call can be a pretty good idea. You miss out on a little bit of upside potential if the stock takes off and goes through the roof and gets called away. But if it goes up less than that, then you collect money, make money on the stock, and keep the stock. And if it goes down, then you've partially offset losses that you would have experienced anyway. You should know that there's a very similar strategy called the married put, in which you buy the stock and then buy a put. So this is essentially hedging against downside moves. If the stock goes up, then you lose from your profit the amount of the premium you paid, basically for insurance. If the stock goes down, then your loss during that downturn is going to be capped, because once you hit the strike price, dollar for dollar, your put will gain at the same rate that the stock loses value. So the difference between your purchase price and the strike price will put a cap on how much you could lose during this downturn. And you might ask, why would I buy a put to turn my position into a married put instead of just selling the stock if I think it's going to go down? And one of the main reasons here is that there can be a lot of tax implications from closing your stock position. Actually selling your stock for real can trigger tax gains or tax losses or a wash sale or other positions you may not want to be in. And by doing a married put, you can get most of the same benefit of selling your stock by being hedged through a downturn without actually having to close your stock position and trigger a bunch of possible tax implications or other financial implications. So as the final part of this basic overview of options, I did want to give you one more advanced example of a complex option strategy that you could take on. And the key that I want you to take from this is that options have more moving parts than stocks. There are more choices you have, there are more combinations you can make, and so it gives you more flexibility to construct a more complex position than you could with just stocks. And this will be a good example of that. So the thought experiment here is, you know what to do in the stock market if you think that a stock will go up, you buy it. If you think that a stock will go down, maybe you sell it if you're holding it, or maybe you even short it if you feel very strongly about it. But what if you have some good reason to believe that a stock is going to trade sideways for quite a while? You think it's entering a calm period where nothing interesting is going to happen with the company, and the stock is just going to flatline and go straight sideways, maybe with a little bit of noise, but not too much. What do you do to profit from that? And if you're limited to just buying and selling stocks, the answer is basically you don't profit from that. A sideways market is kind of the death of stock trading because there's no volatility, there's not a lot of opportunity to find those peaks and troughs and buy and sell and make money. But with options, you can construct a position that will specifically target maximum profit if the price of the underlying stock does not change at all. And that's kind of a cool example of the power of things you can do with options. So let's build one of these. There are a lot of varieties of option strategies, and they all have really fanciful names given to them by options traders. The one we're going to talk about is called the butterfly. And the butterfly is a strategy, as I said, that's specifically designed to profit when a stock or the market is going sideways. So what are we going to do for a butterfly? Let's use the prices that we had before. if you want to look back at the options chain, we said Apple was trading at $111. So what we would like to do is write 2 calls as close to the current price of the stock as we can. And then we want to bracket that by buying a call below that and buying a call above that. So in this case, what I might do is I might buy a 105 call and a 115 call as my bracketing pair. And then in the middle, write 2 110s. The cost of these is going to partially offset one another, making the butterfly cheaper than you might expect it to be for taking a position in 4 options, because I collect the premium for those 2 110s in the middle, and I only pay the premium for the 2 on the outside that I'm buying. And in this case, I'm going to pay $7.16 for that 105, and I'm going to pay 53 cents a share for that 115, but I'm going to collect 2 times 273 in the middle. So this whole position is going to cost me $2.23 a share to enter the butterfly, or $223 because, as usual, I'm controlling 100 shares of stock underneath this. Let's look at the profit and loss curve for the butterfly to understand what it's doing and why this is an interesting idea. So a perfectly reasonable question to ask about this butterfly strategy that we're going to look at is, why is it called a butterfly? And the answer is because it looks like a butterfly. So I should explain a little bit about where these numbers came from. The basic idea of the butterfly is, as we said, we're going to gain money if the stock price doesn't move very far away from where it is now. That's the bet that we're making. And we're going to lose money if the stock price moves significantly in either direction. So we're hoping for a period of low volatility. Please notice I did invert the profit and loss axis on the left simply because it makes the butterfly look more like a butterfly. But don't let that fool you. So we should see why the different points on this graph work out the way we do. Intuitively, it makes sense, given the position that we took, that we would have our maximum profit exactly at that central strike price of the 2 options that we wrote. That's our target price that we hope the stock will stay near. And then our profit is going to taper off in both directions until we reach some maximum loss, because we've created a fully offset position with 2 writes and 2 buys. So once we get to an extreme of the stock price going up a lot or down a lot, those 2 writes and those 2 buys are going to gain or lose value in lockstep, which will put a cap on our loss. And that's a good thing. It means we have limited risk here. So you'll notice our loss and our gain potential are about the same. That's not an accident. That's why we do this strategy. So starting from the left side of the graph, we are looking at a loss of minus $223. Everything we did was calls. So this makes sense. If the stock price goes way, way, way down, then we're going to lose our $223 net premium that we paid to enter this total position after we added up the premium of all of our options that we entered into. Once we reach this point, which is $105 exactly, that 105 call that we bought is going to start to be worth something. Below this, everything was worthless. Our rights that we did won't get called away, but we've already collected the premium and we've factored that into this total $223 it costs to get into the position. So as soon as we hit 105, our 105 starts gaining dollar for dollar and beginning to offset the loss of that premium. Now our 110 is still worth nothing, which is good because those were rights. and our 115 that we bought is also worth nothing. Once we get up to this point right here, then that 105 call is worth $223 because per share we're at 107.23 or 2.23 higher than the 105 call. Our 110 and 115 are still worthless. So at this point, if we exercise the 105, we gain 223. That exactly offsets our 223 premium, and we break even on this butterfly position. As the price continues to increase from there, the 105 continues to gain in value, and so does our total profit until we reach this point, exactly at that central 110 strike price. That's where we would optimally love to be. At that point, that 105 call is worth exactly $5 a share, or $500 total, and our 110 and 115 are both still worthless. So we've now got a net profit after paying our premium of $277 per option contract for the stock price doing absolutely nothing, which is something that would be hard to achieve without an option strategy like this. Now we start losing money as the price goes up. So our 110s now, unfortunately, are worth something to the person we sold them to. And so they're going to be exercised and we're going to start losing money. Our 105 call will offset one of those 110s dollar for dollar and cancel it out. But the other 110 is now going to start actually costing us money dollar for dollar as the stock price continues to increase until we get up to this point here, which is our second break-even point. At this point, 112.77, that 105 call is worth $777. That's just 112.77 minus 105. The 110s that are working against us now are each worth minus $277 per contract, times 2 because there are 2. And you'll notice if you subtract those, you get $223. So the 105 is worth $223 more than what we're losing from the 110s, which means we've just barely offset our premium and we're breaking even again. Now if the stock price goes above that, then we're actually losing money because we haven't recovered our premium. Once we get up to 115, which is this other point here where the graph flatlines, now our 115 call that we bought has kicked in, and it is gaining value now dollar for dollar as the price of the stock continues to rise. So once we get here, the 105 and the 115 are both in the money and are fully offsetting those two 110s that are losing. So every time the stock price changes $1, we earn $1 on the 105, we earn $1 on the 115, and we lose $2 on the 110s, meaning that we go straight sideways and our loss is capped. So this is just one example of what you can do with a more complex option strategy, where we've mixed together 4 calls, 2 buys, and 2 puts with cleverly offset prices to construct an exact profit and loss curve that we're comfortable with when we think that the stock is going to go sideways. We can make adjustments to this any way we want. If we want a wider butterfly, we can give ourselves more room for the stock to move a little bit and spread out this butterfly by buying calls that are further away from those central rights. But we'll end up paying more in premiums to do it. So the wider that butterfly gets, the more premium we're going to lose. You can also do something like unbalance the calls. So on the left-hand side, instead of a 105, I could do like a 100, but still keep the other side at 115. That lets me favor the stock moving in one direction over another. So just widen the butterfly in one direction. And that's going to produce kind of a funny shape in the graph where one wing is higher than the other. And traders actually call that a broken wing butterfly, because again, that's kind of what the P&L chart looks like. And this is how everyone analyzes option strategies. So that's all the time I can reasonably spend on this today. I'm sorry we didn't get into even more advanced concepts. I know some people would like that. But I hope you can take this as at least a basic understanding of what exchange-traded options are, what you can do with them, mechanically sort of how they work and how you pay or collect premiums and what the implications of that are. And then what moneyness is, the intrinsic value versus the time value, and the time decay. That means you don't want to be holding these options when they enter those last 2 weeks before expiration, unless you really, really know what you're doing. And then a little bit of a look into the more complex strategies, the butterflies, the broken wing butterflies, the iron condors, all the different things that people do to express an exact opinion about the stock market through the very flexible instrument that is exchange-traded options. Thanks for listening, and I hope you've gotten something out of the lecture. Enjoy the rest of the class.